Good afternoon, everyone. My name is Darcy. I'm the Governor of the Reserve Bank of New Zealand, and it's my pleasure to present the monetary policy challenge this afternoon. So we have decided to keep the official cash rate unchanged at 1.75%, and this is based on the fact that we expect over the next kind of 1 or 2 years, over the medium term, the balance of inflationary and deflationary pressures that we're experiencing in New Zealand at the moment will cause inflation to remain between that 1 to 3% band that we're after. So New Zealand's most recent data shows that we've got an unemployment rate of 1.1%. So obviously that is within that band that we're targeting, but it is below the ideal 2% point that we really want to be aiming for. Then we've got the policy target agreement as agreed between myself and Finance Minister Grant Robertson. So basically we aim to keep inflation between the 1 to 3% point with a focus on that 2% kind of middle area. And we'll also seek to ensure that the financial system operates as it should, and that as per the new policy target agreement, that we avoid unnecessary instability in things like employment, output, interest rates, and the exchange rate. But we also want to avoid responding to events that only have a temporary impact on inflation, like at the moment we've got that 1.1%, which is not ideal, but we're kind of not too worried about that as of yet. So I'd now like to hand over to my colleague Liam Milbank. He's going to be speaking about the range of inflationary pressures that we are experiencing in New Zealand at the moment. Liam.
Thank you. So to understand how to keep inflation within our target range of 1 to 3% in the medium term, we must examine the pressures within our nation that drive inflation upwards. Now, we began by breaking these pressures into strong and weak, based on how much of an impact we perceive them to have on the price level of the nation. Now, to begin with, migration is historically high. As a result of this, consumption is increasing rapidly due to the influx of potential consumers, subsequently driving up aggregate demand. Furthermore, the decrease in unemployment to 4.4% within the natural rate of unemployment's range of between 3 and 5% will also cause an increase in aggregate demand. This is because as unemployment falls, consumption rises. More earners means more spending. Now, New Zealand's capacity utilisation sits at 93.5%, and along with this, the output gap is sitting extremely close to zero. When combining this with fairly constant GDP growth, with a fairly constant GDP growth rate at 0.6% across the last 2 quarters each, we expect to see an increase in GDP once again, and a constant output gap. This shows the increase in aggregate demand, as with the constant output gap and increasing output, aggregate demand must be rising. The expected inflation rate in 1 year has a mean value of 3%. As consumers perceive that there will be higher prices in the future, they will increase their consumption now so as to avoid having to pay a higher price, increasing aggregate demand. Here we can see that the expected increase in wages, driven largely by Labour's policy to increase the minimum wage to $20, will drive up aggregate demand through an increase in consumption. Furthermore, this increase in cost will simultaneously decrease aggregate supply. Government spending has been rising and is expected to continue to rise, reaching in excess of $80 billion in 2018. As a component of aggregate demand, this increase in government spending will cause an increase in AD. The steady increase in commodity prices will also cause an increase in export receipts for New Zealand, as all of the major exports have prices that continue to trend upwards. As such, this will cause an increase in aggregate demand. Terms of trade are calculated by dividing exports by imports, and as such, when the value exceeds 1,000, as it does here, exports outweigh imports. Therefore, we can confidently say that this will cause an increase in aggregate demand, as X minus M is a component. As such, we can see that there are a large quantity of inflationary pressures, particularly those acting on the aggregate demand side, and subsequently it is clear that these factors are driving inflation. I would now like to hand over to Anne Villy.
So several market forces, including consumer confidence, exchange rates, house price expectations and affordability, can produce significant impact on the New Zealand economy, but are not expected to affect inflation to the up or downside for the medium term. Firstly, New Zealand consumer confidence has risen to 111.2 in Q2 2018, and that's 3.8 points up from the first quarter. Despite the falling unemployment and government spending in social services, the limited upwards movement in wages and potential external shocks have resulted in our anticipation of the stable consumer confidence in the medium term and its minimal influence on consumption spending. Next, we can see that NZD-USD rate has stayed in the 70 to 75% range for the last 3 years. Furthermore, the TWI is assumed to stay broadly stable around 75 over the next 5 years. Therefore, there is a certainty for net export price competition exerting neutral pressures on inflation. However, we are aware that the external factors can also cause a depreciation, increasing the import costs and net exports, which can lead to inflationary pressures. Finally, the cooling of New Zealand's housing market has reduced the inflationary expectations for housing prices, especially for Auckland, which has fallen in March 2018, matching the actual stabilisation of house price increases. Although Auckland's house price to income ratio has fallen from the historically high affordability limits in 2016 at 9 times, it is still extremely high, and New Zealand ratios have continued to rise. Thus, we expect the wealth effect to be limited, restricting the possible impacts on consumption spending and aggregate demand. For these reasons, we have placed consumer confidence, exchange rates, and house prices as currently neutral, even though they have the ability to be influential in the monetary policy decisions in the past and the future. Now I would like to hand it over to Gemma to talk about the deflationary pressures.
Deflationary pressures are described as the economic conditions that cause a decrease in the price level of a nation, which occur through either a decrease in aggregate demand or an increase in aggregate supply. We have divided these deflationary pressures into being either strong or weak. As shown on this graph, over time since 2014, migration has been at historically high levels, likely due to the strong job market here. Therefore, as migration increases, we will see a decrease in the average labour costs. Due to this, a fair amount of businesses' cost of production will decrease, therefore seeing an increase in aggregate supply as it is now relatively more profitable for them to produce these goods and services. As a result, this will increase aggregate supply, and this will in turn put a downward pressure on the price level. As shown on this graph, we can see a decrease in business confidence over time since the 2017 election, as it is apparent that businesses are less confident in the economic environment, likely due to the new government. This will lead to a decrease in investments as businesses feel as though it is too risky to purchase new capital goods. As a result, this will see aggregate demand decrease, as investment is a component of aggregate demand, thus leading to a decrease in price level. If government balance is greater than 0, then the ratio of government spending to revenue is lower than if it was negative. As such, we can conclude that due to the expected surpluses, the government is taking out more money than they are putting in, and subsequently aggregate demand will fall relatively, therefore causing price level to fall as well. As shown on the graph, we can see that an increase in productivity over time. As a result of an increase in productivity, we will see a decrease in cost of production, as it will now be relatively cheaper to produce each good services, and as a result, this will see firms more willing and able to supply more, as each good and service will now be relatively more profitable for them. This will see aggregate supply increase, which will cause a decrease in price level. Though the RBNZ has kept the OCR at 1.75% over the last year, registered banks have increased mortgages rates to near 6% for floating, mostly due to higher lending costs from overseas, as NZ banks get at least 30% of their money from overseas, effectively creating contractionary monetary policy without action from the RBNZ. I will now hand back to Darcy.
Alright, so just to conclude, you can see our graph here, ADAS model. So we expect aggregate demand to rise to 80 2019. There, as the inflationary pressures that we're experiencing from things like the historically high migration, low unemployment, they more than offset deflationary pressures caused by the low business confidence and the government surplus. We also believe that aggregate supply is going to increase as well to AS 2019 as productivity rises and high migration rates kind of mitigate the wage cost pressures that businesses have. And we're also moving potential output as well to YP1 because the kind of increases in aggregate demand and supply will shift the inflation rate to within the 1 to 3% band and should track towards that 2% midpoint as well, which is what we're aiming for. And that's just the shown there. All right, thank you.
Great, thank you very much. You all did a very good job presenting. So we'll move on to the questions, and these will be in the same format as last time, basically. So we'll ask you the question, give you a couple of minutes to discuss and answer amongst yourselves, and then get one of you to present a clear and concise summary back to us at the end. So for the first question, what would you be looking for over the next 12 months that would make you cut the OCR?
That's cutting the OCR, right? So it's kind of a it's going to be pushing up consumption, aggregate demand kind of thing. So it's going to be stimulating the economy. So if we see that business confidence maybe get a lot worse than it is, we see that kind of flow through to real world investment businesses.
So what we're looking for is either a decrease in our inflationary pressures, right?
Yeah.
Or an increase in the prevalence of our deflationary pressures. So I think business confidence is a major one,
Yeah.
because if that continues to stay at the level it is, that's not stimulating for the economy, and that also flows on to growth.
Yeah,
I think that
to investment. If consumers start to get a bit scared from like kind of external factors happening around the world as well, so you've got like,
but we don't want to respond to that with a change in the OCR.
if we kind of if it's a big overseas
As in it begins to affect consumer behaviour.
yeah, then when it starts to affect consumer behaviour, then I think we'd want to have a look at
Okay, so say
OCR as well.
any decrease in our inflationary pressures, any increase in our deflationary pressures, and in particular with a major focus on business and consumer confidence.
Yeah.
Okay, all yours. And really, Patrick, guys have anything on that?
Yeah, I think as Liam said, we shouldn't respond to temporary changes, but however, if the change is consistent, then we can consider changing the OCR,
Okay,
considering
so-
there's a transmission lag of 18 months.
Okay, so if there's across the next 12 months consistent decreases in confidence as a result of
Because if it's temporary, it'll just filter through the economy anyway.
Yeah. Okay. All right.
Right. So basically, we think over the next 12 months, if we start to see sustained hits to business confidence, it's already historically low, but if we see that start to flow through into actual investment, then we'd want to have a look at some stimulating kind of monetary policy as well by cutting the OCR. Also, consumers at the moment, they're pretty happy, but that could change in the future, especially we've got a lot of volatility overseas, so if they start to get spooked as well by things like the possible trade war, we've got crises in a number of Latin American countries as well, so if they start to get spooked by something like that and we see it sustained over the course of a year, then I think yes, we'd probably want to start having a look at possibly lowering the OCR. But of course, if it's just a temporary thing, then we want to respond accordingly to that and not shift the OCR.
Great, thank you. Next up, why is it important for the Reserve Bank to consider a range of measures of inflation, such as tradables inflation, non-tradables inflation, and core inflation?
To consider. Sorry, so that was tradable inflation you mentioned, and also
Non-tradables and core, just some
Non-tradables.
examples of the
Okay.
ones we look at.
Darcy and Patrick, this is your territory.
So then talk about the difference.
Okay, so obviously you've got headline and core inflation. So headline inflation, basically straight out of the CPI. It kind of includes the prices, the seasonality of goods. So you've got the example of.
Do you got like supply shocks? So like
Patrick, talk to Darcy.
yeah, so you've got like supply shocks. That is included inside headline inflation, but core inflation, there is no. It doesn't take into account the
Yeah, removes the price
volatile prices. Yeah, and then you have
Tradables.
tradable inflation, which is goods and services that are exported or like consumed overseas, like right. So non-tradable is goods and services consumed in domestic
I think
market.
the question is, why is it important to target all of them?
Right.
Don't lose track of the question.
Yeah. So sorry, what was it? Non-tradable is the
So goods and services that aren't traded, so consumed domestically.
Right.
Yeah.
Why is it important to target all of them?
because
We can't just represent one.
yeah, because you've got headline inflation, even though it's not something we can do a lot about, it's still affecting consumers, right? It's still
Still has an effect
have
on
certain
It's
costs.
important to
Yeah.
target all of them because the Reserve Bank's goal is not necessarily to target inflation, it's to stimulate the economy. And a key way of doing that is through the targeting of inflation. Right.
Well, one of the core goals is price stability. That
Yeah.
is one of the
Yeah.
most important goals.
But
So-
we're not targeting price stability for the sake of it.
No.
We're targeting it because it's good for the economy. So I think that's the massive thing that's important. But
Yeah.
you know more about the types than I do. So we can handle it.
Do you want to take the answer? Or Harry?
Okay.
Okay. So essentially, so things like headline and core inflation, it is important for the Reserve Bank to look at something like headline inflation. I don't think there's a lot the Reserve Bank can do about it really, because you've got things like, let's say, avocados in the winter. They're not, they're going to be really expensive. That's going to affect the CPI, but there's nothing really that the Reserve Bank can do that will change that. But it's when you start to see that kind of flowing through into core inflation. So let's say there was a massive drought, avocados in summer were now very expensive. That's something that's going to flow through to core inflation, and so that's the inflation that the Reserve Bank targets, because that's the inflation that the Reserve Bank can do something about. And so consumers also kind of expect to be paying a lot, kind of depending on seasonality, whereas they're kind of, if they start to see those increased costs in times where the good is previously not that highly priced, then they will begin to kind of have those adverse effects as well from inflation. And then you've got tradable and non-tradable as well. Essentially, Patrick, you were saying it was basically...
So tradable inflation is the inflation of goods that can be exported or consumed overseas, whereas non-tradables are inflation are goods that are consumed domestically in the local market.
Right.
So, yeah.
Yeah. So essentially, goods that we're consuming here, so the non-tradables, that's what we want to look at really. We're not too concerned about tradables, what they're kind of paying overseas for goods. That's not what the Reserve Bank's about. We care about New Zealand, and so the non-tradables are kind of what we want to be looking at there as well.
Okay, very good. Just a quick follow-up question. According to the Policy Targets Agreement, what is the measure of inflation that we're supposed to target?
So there's the... We've got the policy target agreement right there. CPI inflation. Yeah. Yeah.
So yes, that was a simple question. So here's the real question.
Yeah.
Given that there's a range of measures, so you talked about that, but we have to target that specific one. Is that a good idea?
For CPI.
Okay, so here's
So is it good to target CPI inflation,
Well, it represents
essentially?
different basket.
Okay,
It's for the average household.
Yeah. So
All households are different.
okay, but instinctively, I think the answer is yes. It is a good thing to target because you have to go that you cannot target everything. In a perfect world, yes, we would like to target everything. However, no, we can't. We are aiming to have price stability because it's important in allowing households and firms to make decisions about the future. Without price stability, we can't do that. The consumer price index is a good measure of how much someone's going to have to pay for something. Can I take this one?
Yeah. So I'm just writing down a couple of notes here.
Just to add up to that,
Pardon?
we just look at CPI and not look at tradable and non-tradable. We won't be able to identify the causes for what might be. It might be overseas external supply shocks.
So it's a narrow solution.
Yes.
However, so it's not
It's not perfect, but it's
It's
almost
not ideal.
Sorry, can you please repeat how the question was phrased exactly?
Yeah, I'll try. So, according to the Policy Targets Agreement, we target the Consumer Price Index as measured, all groups' Consumer Price Index as measured by the Stats New Zealand. Is that a good idea?
Yeah. So essentially, yes, because
So most ideal is
it's
not
the
strict.
average kind of.
So in general, it's pretty good and measures most households well.
Because it's
Yeah.
for the average
Yeah.
household.
Yeah. So it's all
Because
about
most
averages.
people
We
within the
can't
average band,
target
there's a few streams
everything.
on
Okay.
the same household.
So
To answer the question very, very simply, we would say yes. Now, the reason we believe that is the Reserve Bank is targeting price stability, look very, very simply, as a manner of ensuring that households and firms can accurately predict what prices will be in the future, and that they are not acting in a market that is economically unstable, wherein the price of an apple is $1 one day and $10 the next. It's not Zimbabwe. We want some level of ability to predict where the economy is going to go. So we believe that the CPI accurately reflects the experience of your average consumer in New Zealand. It is quite literally a measure of what the average consumer in New Zealand purchases. So therefore we believe it is a good measure. We do believe that although it is good to target CPI, the Reserve Bank should remain conscious of other levels of inflation. Tradable and non-tradable inflation, headline and core, it is all worth considering because these are factors that still come into the economy. The Reserve Bank merely targeting the CPI, we think is a good decision, but we think it should evaluate and look at all versions of inflation because they are still playing a role in our economy.
It's also just, I think, worth noting that, the CPI, certain goods are weighted a bit higher than other goods. So I think cigarettes are weighted a bit higher than other goods. And, oil obviously has a massive effect on a whole range of goods in the CPI. So yes, looking at it, keeping it under control is a really good idea, but just by itself, you need to have a little bit more than that, I think.
Okay, good, thank you. Just changing tack slightly, how do you think monetary policy can affect or not affect employment?
I'm immediately thinking of the Phillips curve.
Yeah.
Right. Yeah. Policy effects. Employment. Yeah. So basically, Phillips curve you've got in the short run, anyway.
Mm-hmm. Okay, it changed on. All right, draw the model.
So you have higher inflation equals what you've kind of got. Lower unemployment is kind of causes higher inflation.
Yep.
Because
we're looking the other way around. We're looking at what does inflation do to unemployment, because we're going, all right, so you change the OCR, you're getting a change in inflation. How does that filter through? So
by changing the OCR, we can manipulate the consumer and consumer confidence and business confidence. For example, by lowering the interest rate, we can encourage spending, and that will increase consumption spending. And that will also encourage the investors to invest in their businesses, so that will increase the investment spending as well. So that will.
So lowering the OCR will cause an increase in employment.
Inflationary pressure.
Yeah, but you're saying employment as well, there, aren't you?
Pardon?
Are you saying an increase in employment? We're talking about employment.
So okay, so
Sorry, I missed what you said at the end.
Yeah. So firms are encouraged to invest more.
Yep.
They are going to hire more workers.
Yeah, that's what I thought. Okay, cool,
Yeah.
sweet. Yep. Okay, yeah. So
you've got a pretty good grasp.
yeah, I think you've got this one, Emily.
So we think that by changing the OCR, we are able to, for example, by decreasing the interest rate, we are able to encourage consumption spending, and we are also able to boost business confidence, and that will lead to an increase in investment levels. And by increasing the investment levels, the firms will seek to hire more workers from the labour market, and that will lead to them hiring more workers and therefore decreasing the unemployment rate of New Zealand.
Good. Want to add anything? Yep.
So essentially, you've got consumers spending more, so businesses are going to kind of respond by kind of selling more, I guess, and so their revenue is going to be increasing. So as their revenue increases, really, as a result of the kind of expansionary monetary policy, if you like, their profitability rises. They're going to want to kind of produce more, and they're going to hire workers to do that. So in a sense, that has an effect on employment, because if producers are producing more, they're going to need more labour, so they're going to hire more people, which is going to lower the unemployment rate.
Are there any limitations to how monetary policy can affect employment?
Limitations to monetary policy.
Well, our capacity capacity utilization is actually close to the full level.
Mhm.
So
That's right. So
yeah, so we are at a stage that the
Yep, and we don't-
business wants to hire more workers, but we are unable to because
yeah,
they're already
and once we
engaged
get
in
out past there on AS, that's just so steep that you have ridiculous levels of inflation for moving up a small amount along the curve.
Yeah, essentially in the kind of natural rate of unemployment.
We're natural right now, so we can't.
Unemployment rate.
Yeah, and currently we are already sitting at
So we're at 4.4. We're in between 3 and 5, so we're natural.
Close to output gap. So when we begin to exceed the output gap, we're going to see widespread inflation and not a lot of growth. So that is not going to kind of
So
affect
stimulate, yeah.
employment a lot, really.
Yeah, and from the equation MV equals to PQ, by if we are increasing our velocity of spending by and either the price or Q will increase, but now we are nearly at our full potential, so Q won't be able to increase anymore. Like Liam said, the price is just going to spike rocket high.
Yeah. So essentially, right now we're pretty much smack bang in the middle of the natural rate of unemployment, 3 to 5%. We're around kind of 4%, 4.4% level. So there's not really a lot of room for us there, especially because we are so close to potential output, really. And a situation we really want to avoid with which expansionary monetary policy at this point in time could actually provoke is us going past that potential output, and that's when you start to see not a lot of growth, so therefore not a lot of effect on employment, but lots and lots of inflation, and that is absolutely something you don't want to avoid, which is why at this stage
Do want to avoid
we do want to avoid that. Yeah, we do want to avoid that. So at this point in the cycle, with us pretty close to potential output, expansionary monetary policy is not going to affect employment that much because we are very nearly there. There's not a lot of growth left that we can really achieve sustainably, I think.
Okay, thank you. I think we've got time for one more.
Yep. So, how might government policies affect the Reserve Bank's objectives?
Right, okay. There's a lot of stuff to talk about here.
Yeah, I think this is once again falling heavily into your domain. When we say government policy, are we just talking general government policy, do you think?
I think we can narrow it down to this government's policies as well.
Yes, okay, I like that. All right, I think we talk about wages.
Yep, so we've got the wages rising to $20. The
Reserve Bank's goals.
Reserve Bank's goals.
Okay.
When you say on the goals, do you mean the goals that are selected or the measures of the goals?
Primarily the goals that are selected.
Okay.
Yeah, so we've got unnecessary instability and kind of employment output, that kind of thing, and also that 1 to 3% midpoint of 1 to 3% target, of course.
If we're looking at overseas, US is currently experiencing a problem where they have a recent tax cut, and that leads to inflationary pressures in the US economy, and Reserve Bank have to increase their interest rate. The Federal Reserve have to increase their interest rate in order to combat that. Right?
Okay, yeah.
Yeah. So I think you're talking about more in a general kind of New Zealand sense. Am I correct?
Yeah, but you could totally apply that to
Right. Yeah.
New Zealand, yeah.
Right. So you're saying so the US is
Okay, you two tag team it.
so you've got.
If we have any change in government policies such as tax cuts, then our response by changing the OCI might have negative impact on our economy.
Right, so if the government's doing expansionary monetary fiscal policy,
Fiscal,
then,
monetary is us.
yeah, expansionary monetary policy, fiscal. Yeah, then we want to keep that into account. We might have to do some contractionary to.
And also, our now we experience a high wage expectations, right? We have
Yeah.
we are looking for a higher minimum wage as well, and well, quote my math teacher, that's exactly on a strike now, and teachers are about to do so as well. So we already see a wage increase in the private sector. So the workers in the public sector are seeking for a wage increase as well, and that will cause inflationary pressure in the economy as well. And
Yeah. So
because the wage is meant to rise to $20.
Summarise.
by
yeah, so
2020.
essentially, in a general sense, not talking about this specific government, you've got things like they could spend lots in the economy, up their government spending. That's obviously an expansionary measure. Or you could do what they've done in the US as well, which is cut taxes, and that's also expansionary as well. So
It drives consumption and stuff.
Yep, so that drives consumption, both of those things. And so that, of course, affects aggregate demand, and it's going to cause inflation to rise as well, especially because at this point in time we are close to the potential output as the US is, so a similar situation would occur here. But specifically, this government increasing the minimum wage to $20 per hour by 2021, basically that's businesses are a bit worried about that because it's going to represent a significant increase in their costs. So they're going to drop their aggregate supply, and that's going to be an inflationary pressure as well. So as the Reserve Bank, we want to have a look at possibly having to counteract that, because there are also other measures that the government has introduced, like the changes to employment law, which has also got business a bit worried. So they're going to not only be less confident, they're going to probably lose a bit of their profitability as well as their their costs rise from having to enforce these new laws. And so as the Reserve Bank, we want to possibly have a look at changing the OCR to counteract that. So we might have to increase it a little bit depending on if the government policies have that inflationary effect that they would do. So yeah.
Okay, thank you. You can now relax. There are no more questions. And we'll see you this afternoon in the museum.
Well done.